Good morning and welcome to Cape Cod, home of the Pilgrims, where you're watching the Short Vol Show live. And we have another pretty typical day with the futures up coming into the open. NASDAQ up 115, E-minis up 24, and Dow futures up 155. You know, we're in one of these periods where this shorting volatility trade seems like it's like the easiest thing in the world. You know, you short UVXY or VXX and you just leave it and it goes down every day. For those of you who have been trading this VIX stuff for a while, you remember 2017, like the whole year was like that. Just every day it would either stuff would go sideways or these products would move down. It just went down, 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 down. And it was like, in fact, people were like writing mini books on it and saying, you know, putting all their money in it and saying like, this is the easiest thing in the world. Of course, you know, with trading, it's the easiest thing in the world until it isn't. But for the time being, look, here's a chart behind me of VXX. If you had, you know, just shorted it from, you know, when that spike happened during the initial COVID outbreak, if you just shorted VXX and just left it, look, we've just walked down since then. And that has been really true since the election. We've gotten this big swoosh down, right? Boom. Now, there is some sort of floor, of course. We are approaching 20 in the VIX, but there's no reason to think that it has to stop at a 20 number. Right now, if we look at the VIX chart, you know, we've come down significantly, right, in the last little bit. Here, we came from 40 down to 23 in just the last week. That is a lot of the reason for this down move, but also we have the term structure now working in our favor. It's like everything's all of a sudden in our favor. So if we pull up the term structure, here's the term structure, and it has this ad blocker thing now. But here's the term structure, and you can see we are now in contango, right? So that means that the front 2 months, we have 3.5% contango. Now, when we're looking at this term structure, the only months that matter are these first 2 months. These are the only months that are what UVXY, VXX, SVXY are composed of, is these 2 months. And every day as we move forward, the formula demands that, or requires that, volatility is sampled, or the VIX is sampled 30 days out. So, and these futures all have a set expiration date. So as time goes by, every day, the proportion of each future that makes up UVXY, VXX, SVXY is rolled out a little bit. So for example, right now we're somewhere in the middle of the month. So we are a certain proportion of November futures and a certain proportion of December. And as the next day goes by, they will take about 1/30th of the futures and move them from November to December. And when we have stuff in contango, thus when you have the back month higher than the front month, the money that you sell these November futures for goes into buying these December ones, and basically you're able to buy less December ones with the same amount of money since it's a higher price. Another way of thinking of it is just that whatever cost basis you have for shorting VXX, it kind of moves higher up. The price that you sold VXX for kind of moves higher up every day as this rebalancing occurs. And when we see this number at the bottom of the screen, 3.6%, what that means is essentially that this value is going to go down by 3.6% per month. And it doesn't happen, there's no like loss of money in the actual rebalancing. However, it just, over time, you can think of it as these futures are slowly falling towards spot, and as we rebalance, it moves away from spot a little bit further, the futures. And so the futures have a little bit more room to fall as time goes by because they're being rebalanced out away from spot. And that little bit more room to fall towards spot creates edge and opportunity for the downside. Now, the opportunity might not always be realized, but the opportunity is created. So if we go to our little clipboard here, what I'm going to do is sample this so we can go with the clipboard here. Okay, so if this is the term structure, let's see if we can get a pen here. Can we get a pen? Here's a red pen. All right, so as time, it's a very small pen. So as time moves by, each day goes by, at one point we're at this point in the month, and then the next day we move out a little bit and slowly move out towards the end of the month on expiration. These products will be made entirely of the December future, and then we'll move on to the next month. So as time goes by, we're moving sort of up this curve. And so these futures are always falling towards spot, but the rebalancing is pulling them away from spot at the same time. And what this does is it creates this kind of circular, perpetual money-making machine for us being shorted, because it's slowly decaying this product as this process continues. The process of the futures rebalancing upward away from spot as they fall towards spot over time. And this continues over time, and this is what creates the process of these products slowly going towards zero. If you look at, like, take a chart of UVXY over time, you see it slowly falling. So if we go to a 3-year chart here, it's slowly falling. And if we can expand this time frame to, let's say, 10 years, and you get something like that. It went from, 2 zillion down to zero. And this is because what happens is as it gets closer to zero, they reverse split it. And so it never is able to actually reach zero because they keep reverse splitting it over and over again. And UVXY is now 13. So you're going to start hearing people asking, when's it going to reverse split? When will the next split be? And usually the answer is they won't start doing that until it gets below 8. Now, if we look at UVXY, let's see, we're close to the all-time low, right? Okay, so the all-time low is 10.4. So we're approaching again the all-time low, and it is pretty amazing. Look at this series of events that got us from 10 back to now where we are at 13. That's an amazing series of events, and usually you don't see a year like this. We're still up since the low, right? We still haven't made a new all-time low. This is one of the longest periods of time that we did not take out the all-time low in UVXY in the history of the VIX due to this tremendous spike. And volatility, if we can plot this versus a look at the VIX, volatility is still high. 23 is still a pretty high level for volatility compared with historically. Now, it has stayed at periods high like this for long periods of time. There's no reason why it couldn't stay above 20 for a continuing period of time. But here we're charting the VIX in purple, and I've been standing right in the way of this, haven't I? I apologize. So here I have purple is the VIX, and Oh my gosh, I was right in the way of that for a long time. I'm sorry. And so the VIX down here before all this stuff was down to like 1390, right? And you had a 10, that representing a 10 in VXX. Now we're up around 23, represents a 13. So we have exhibited already some decay here, right? If the VIX were to go to 10 now, UVXY would be significantly lower than, I'm sorry, if the VIX were to go to like back to 13 where it was then, the UVXY would be significantly lower than 10 now. But this just shows we are still, you could still argue that we're coming off the COVID spike still. And that's been the story of this whole thing. We're still on the COVID spike. So pretty amazing. So I wanted to talk about the title of this video for a second and my journey yesterday, which was kind of a mess. So let me just describe the trades I went through yesterday. So I came in and I've been messing with this March stuff, right? So I came in and I bought March puts. I bought 40 of the March 17 puts yesterday. If we go back through all of these trades, it's just been ridiculous. So yesterday was the 10th, and I bought, here's my trade. Let's see, are these in any sort of order? So bought five of these puts, 275. But okay, so here's the total. Bought 40 of these puts around 275, right? 275. So then I get a little skittish, so I want to sell something against it. So I go and I sell 40 of the December 17 puts against them at 91 cents, which kind of flattens out my delta. So then, but then it starts to move lower, and so I want to get shorter again. So I go ahead and I buy a different strike of the 17 puts to get shorter. Then I get skittish again, and I hedge those off. Then I get bolder again and want to get shorter, and I buy more stuff. So I'm going back and forth, hedging my position, and then getting short again. And the end result is, look at all these contracts I ended up doing yesterday, and it's going to represent like over $100 in commissions, which is ugly. You know, when you have a small account, and this was a relatively small account with like, 10 grand in it, you don't want to chop up $100 in commissions in one day. And in fact, looking at my year to date, I've spent something like $8,000 this year on commissions. The VIX trade is a long-term trade. We talk all the time about how the term structure and contango is a long-term effect. There should be no reason to be trading like a maniac day to day, minute to minute. It should be able to just leave your position and not chop yourself up. But this is kind of an example of what not to do, and just spoke to the fact that I started to get skittish yesterday and think that like, the market's going to tank or something. And I really wanted to protect the 6 days in a row of profitability that I've had, and thus I chopped myself up. And, that hurts. This is like, a couple hundred contracts, and that eats up commission. So this is something you don't necessarily want to be engaged in yourself. Hopefully some of the things that I do that are mistakes you can learn from, so you don't have to make them yourself. All right, let's see if we can go to the chat here for a sec and say hi to everybody. The market is at an all-time high. Shouldn't premiums be high? Yeah, the some of the stuff. Good morning, everybody. It's great to see all the members in the group. Wyatt, this is a thing that people get confused about a lot. When you look at the price of UVXY or VXX, the price of VXX or UVXY does not have any connection to the VIX price, right? It's a separate ETF product. So, a VXX of 19 doesn't mean it's 19 volatility, because remember, these products, they go down, they get split. If they reverse split this right now, it could be $100. If they reverse split this right now 5-to-1, it would be a $100 issue. That doesn't mean it's 100 vol. The price of these does not relate to a volatility level. It sometimes seems like it does because it's similar to the volatility prices, but these products, they slowly move lower. Same with UVXY. If you just look for a second at a chart, like this chart behind me, and see how this sells off, this doesn't mean volatility's it looks, when you look just at that, like it's following the price of the VIX, but that's just kind of incidental. If you look over a longer period of time, you see that it just doesn't. You can see the price axes are different on this, but maybe TVIX is a better example to show you. But yeah, the price doesn't correspond to a volatility level. It's its own thing. So, for example, if you look at TVIX here, when volatility got up to I don't know why it says it got up to 45 there, but when volatility cranked earlier in the pandemic, TVIX got up to 1,000. That doesn't mean TVIX was 1,000 volatility. It's the price is independent of volatility. So if you want to compare them to the futures, you just want to look at the percentage move. So if you see that, if we're mostly made up right now of the November future, if the November future moves up 10%, then UVXY should move up 15% because it's 1.5 times leverage. So if you want to compare these products to the futures, you have to look at the percentage move per day. That's the only way to really compare them to the futures. It's just incidental that the numbers are the same at this particular moment. So let's and let's take a look just for a second, just out of curiosity, to see what the weighting is right now in UVXY. So if I go to the ProShares website and look at the UVXY daily holdings, and I get out of the way once again, we can see. So UVXY right now is, there's 55,000 of the DEES futures, and there's 18,000 of the NOVE futures. So we are, getting closer to expiration for NOVE, and the majority of UVXY is the DEES futures now, and that moves every day. When you look at this, this is like yesterday's, what it was yesterday. And when you look down here, you're going to see these other things, iPath series swaps. It has a small, the notional value of the swaps is very small compared with the notional values of the futures right now, right? You've got, several hundred million of each of these, and then only $30 million worth of the swaps. But the swaps is something that it acts like the same ratio of futures in many cases, but it saves them on certain fees they would have to pay. So this is why they use swaps sometimes. But you can see we're pretty heavy on the December future as we get closer to expiration right now. And in fact, when you're curious on this VIX Central, if you're curious about exactly when expiration is, you can just hover over November, and you can see expiration is the 17th for November. So that puts us next week, right? So we've got a week left till expiration here. And as we get close to expiration, you're going to see that this front month future is going to start to hug closer and closer to the actual spot price. When we've got several weeks out, November could bounce all around in different prices to the spot. But as we get closer and closer to expiration, it's going to start to hug spot. And you'll see that happen as we get into, definitely into like Monday of next week, that the futures, the front month future will hug spot more and more. So I guess people are kind of wondering, maybe, is there a floor here? Is there a spot where, well, we can't really go lower, or people are going to start defending a certain price, or there's a certain price where volatility is just too cheap. And I would be careful about that, because a lot of times once we start moving in one direction, like for example right now volatility is coming in, once you start moving in one direction, it can go way past where you think it's gonna, right? So we could go through 20, we could go through 18 and keep moving south, and it would be a mistake, in my opinion, to start defending a certain price, like saying, oh well, once it goes through 20 I'm going to load up. Because a lot of times the market just keeps rolling in one direction for longer than you think it's gonna. And I certainly wouldn't be surprised if we break 20 again soon, especially when we're at all-time highs. Remember, this is the time when volatility, is typically the lowest, is when we're at all-time highs and we're slowly moving higher. That is like the best case scenario for the market. So that's when volatility generally is lower. That kind of was reversed before, when we had that huge sort of gap up, and we kept making new highs a couple months ago, and it didn't seem to really make sense because there wasn't really great news out, but we continued to make all-time highs, and many people were very nervous that we were at all-time highs. That was kind of an exception to the rule. If we're just slowly grinding higher and slowly, every couple days making a new high, that is the time when volatility does collapse the most. So if we continue to just kind of roll higher like this, especially if it seems like politically we're going to be kind of balanced, sort of in gridlock, where the Republicans control the Senate and the Democrats have the president, and that kind of gridlock is the kind of thing the market likes because it's predictable and there's certainty about what's going on. Love or hate the past president, we don't expect to have 3 a.m. tweets from Biden moving the markets. And so there's definitely a case to be made for lower volatility. Now, I would say like the different press organizations are going to make less money because there's less to report on with a, quote unquote, Sleepy Joe president. But markets like certainty. And this is, what's bad for CNN breaking news may be good for the markets here moving forward. Now, insert whatever comments you have about, the Democrats being bad for business or something like that. But my point, I'm getting distracted on politics again, but my point is just all-time highs usually mean all-time lows in the VIX, and right now we're still above the average, so the VIX could certainly fall way further. Now, I don't know what's going to happen tomorrow. I can't predict, but there is the possibility that we continue to grind lower here, and there's no reason to say, well, 20 is the bottom. Of course, if we get to 10 is pretty much the bottom. We've never gotten below 8.59, right? So, but we are a long way from 10. We sat for years around like the 12 area. So it would not surprise me if the market stays up here. It would not surprise me if we continue to move lower on this stuff. And that's kind of, there you have it. So I was talking a little bit last video about continuing with my journey. So let's just pick up with the trading journey from where we left off. And just to remind you, where we left off was 1994. I was hired by a market maker firm, and so I just wanted to talk about the average day, what it was like then for me. And what it was we would come in every morning and we'd go up to the office. Now, our office was in the same building as the SIBO, and so it was just you come out of an elevator bank and you walk around a corner, and there was the turnstiles to go into the SIBO. So very convenient. But what we would do is in the morning, we go up to the office first, and we would get these big printouts that were like 3 inches thick of computer paper, and we would have to match our positions from our clearing firm, the bank, to what we had on our sheets, and make sure every day in the morning you get what's called an outtrade sheet, and it will show any mismatched trade. So for example, it might show me buying 5 calls from this broker, and the broker might be coming back trying to sell me 6. And so our bank, my clearing firm was Merrill Lynch at the time, and our bank will have specific people who are called trade checkers, and they might come to me and ask me, what do you want to do with this trade? And I might say, usually with out trades, as a market maker, what we would do is whatever the broker had, we would just go the broker's way, because you want to keep brokers happy, right? They're the ones that give you the paper and the business. So, unless it's like a huge amount of money, if there's some sort of error, we go the broker's way. But most of the time, if you're a market maker, even if you've done 100 trades that day, most of the time you're going to remember what trade you did, because this is your life, right? So, out trades, you usually remember the trade, and that stuff gets resolved in the morning. You just look at how much money you made or lost. You think about your positions. You get your trading jacket and put it on, leave your street clothes upstairs, have a cup of coffee, maybe watch a little TV. And that first part of the office upstairs, it lasts for maybe a half an hour. It depends on how early you get there. Some people get in late and just kind of run it down to the floor. But come up to the office, check your sheets. Maybe at that time we were printing out trading sheets. We didn't have computers really yet. Further on, we would have like tablets with us that we bring into the pit. But at this time, we didn't have tablets yet. So you print out some trading sheets that would give you different prices for each stock you traded, and then option prices as the price moved back and forth. It would also show you how much you'd make or lose at a different prices in the stock. And we were taught to put scaled orders in if we owned a bunch of options. And so if you own a bunch of options, right, if the stock goes way down, you're going to have some shares to buy. If it goes way up, you're going to have some shares to sell. We were taught to put scaled bids and offers in ahead of the opening. And so you look at sheets and you kind of make a game plan for each of your stocks. Generally, SIBO traders, you would trade the stocks in your pit. And generally, the company that I was working for, most traders would trade most of the stocks in their pit. So each trader might have a portfolio of like 10 to 20 options positions. And so you kind of get your game plan together in your mind. And then you head down to the pit for the open. And so for me at this time as a clerk, I would be hanging out with other clerks. Maybe some trader would be telling me to run sheets for them or to help them with something. When I first started, I was supposed to be a computer guy, and so I was helping them with computer stuff. So the way it would work is we go up to the office, then we go down, come onto the floor, and our company had a booth that it was like a auditorium booth. It went up the steps went up, and on each side there were little phone booths. So that was where like our hanging home base would be, to hang out there, unless we were assigned to a specific trader and would go stand in the pit with the trader. So my job at that time was to support the different traders. That's kind of how it started. All right, so let's see what we've got going on. Let's take a brief look at chat once again, and then we can move to, I'll let you go. Happy Veterans Day. Yeah, my sister's birthday today. I just called her. Do you try to anticipate moves, tax loss selling in November, December, and profit taking in January? Sell in May and go away. Yeah, it's interesting. Not only, while we're still on the topic of floor trading, when you talk about different time periods, we also, every quarter, there were bonuses, right? And so people would be interested. I'll talk about that at some other time. But I see some of these concepts that Warren the Idiot Masses is putting up, like tax loss selling coming into the end of the year, and we can talk a little bit more about that as we move forward. Last time we had a delayed president transition, had 9/11 intelligence alert slip through the clouds. So Bernard says, I hear what you're saying with the assumed reasons for volatility right now. Last time we had a delayed presidential transition, had 9/11 intelligence alert slip through the cracks. Yeah, I was just reading today. One of the reasons, there's this, I think it's called GSA, that has not signed off yet that Biden has actually won. It's the General Services Administration. And so this lady that works for that administration has to write a letter saying that, they presume that Biden's the nominee. And then this, I think it's like almost $10 million gets released. And they're basically given the keys to the federal government to start the transition. And I guess in before 9/11, there was a delay in the GSA being doing this, and it sort of, the argument is that if they don't do it quickly, it can kind of compromise national security because it gives the incoming government less time to get organized for national security measures, and stuff can slip through the cracks. Of course, Bernard, anything can happen, and of course, we could look back and it could be a mistake that vol came in, and of course, at any time, this could be a buying opportunity. And if some sort of event happens that makes the market go nuts, then buying volatility right now, as opposed to being shorted, would be the right position and would make you money. And that wall of worry is always out there. And certainly, there is a case for being long volatility all the time, and there's a case for being short volatility all the time. And I can't tell you, of course, what the future will bring. I don't know any more than anyone else does what the future will bring. We try to play the odds. We try to make educated guesses, and we certainly can be wrong. There are a lot of people in America who don't accept yet that the presidential race is over, and there's certainly some risk there, but the stock market in general seems to believe that the presidential race is over. And I read an article on it where they're interviewing Jamie Dimon and some other stock market bigwigs, and they were also showing like research reports from Raymond James and Goldman and whatnot, talking about the likelihood that this election gets overturned is very low. Once again, we're always talking about odds here. And we know that the odds-on thing to happen doesn't always come in. That's what odds are, right? Yeah, that's what odds are. So yeah, I don't fault anybody for having a different market outlook than I do, and I'm not saying mine is right. We're all trying to do the same thing, which is make money. Anyways, happy Veterans Day to everybody, and nice to talk to you. And I have been pretty regular on my schedule lately, and so we will see you on Friday, back again with the Short Vol Show live. Yeah, good point, Warren the Idiot Masses. Stock market at all-time highs and the economy is still in shambles. Yep. The stock market does not represent the economy. And the stock market is also forward-looking, and there is some reason for hope now that this vaccine stuff is going forward. However, once again, surveying my friends, most of them are not willing to take the vaccine, so we'll have to see how that goes. Thank you, Wyatt, for nudging me towards a regular schedule. I appreciate all of the suggestions and support from you folks out there. Please consider liking and leaving a comment. I'm trying to grow the channel. It would be great if we could grow to next goal, 25,000 subs. So it'd be great to get more people involved. But I I'm here for you. Who cares about the people that aren't watching right now? The people that I'm here to support and help out are the people that are watching right now, and that's my concern. So thank you, everybody, for supporting me, and I will catch you in the next one, which will be Friday morning. Don't overtrade, folks. I've tried to reach out to this guy to get his approval to use this video, but he doesn't respond to me, unfortunately. Hopefully, I'm helping him out.